As you said, look, it's a very encouraging set of earnings. We are on track to meet the targets which we set out in our financial plan in February. Profits at £2.2 billion are 18% above what they were a year ago. ROTE for the bank, 12.3%, 11.5% year to date. And, our target for 24 was above 10%. And that's true across all the divisions of the bank. We are guiding upwards in our net interest income. And we've had two continuous quarters of NII expansion in our business in the UK. So we're guiding up both for the UK business and for the bank as a whole. And then we see costs very much under control, positive jaws, again, 2 quarters in a row in the investment bank, £700 million out of our £1 billion cost save for this year. And we'll hit our targets again for this year and another billion to go before 2026. And capitalization, 13.8%, well within our range of 13 to 14%. And this facilitates, as you said, the buyback that we announced earlier this year. And so the capital distribution plans are going well.
Venkat, we've got so many questions for you. Let me just drill down into that PBWM figure as well. Am I right in my assumption there that you're disappointed with that 3% decrease?
No, I'm not. The PBWM business is great. If you look at our ROTE in that, it's in the high 20%. And so it's a very profitable business. The revenue top line goes up and down a little with interest rates and deposit volumes. But it's a very, very good and strong business, one that we're looking to grow.
OK, thank you very much for clarifying that. So high margin on that one, but it's lowered levels of absolute sales as well. Look, just tell me about the environment as well. Thank goodness we've got the election in the rearview mirror. That was talked about way too much in the United Kingdom. We've also got interest rate cuts now as well, which on one level will affect your net interest margins, on another level might mean perhaps lower delinquencies as people find it easier to service their debts as well. But we have got this key issue, and I know you've been working with the government, with the Chancellor, on potential growth strategies, wealth management strategies of the country as a whole. How do you see the importance of this budget coming up? Quite frankly, I think the government has talked us all into a situation where we're terrified to spend a penny.
Well, first of all, what I would say on interest rates is Barclays has had a very disciplined approach to interest rate management. And so we've got this thing called the structural hedge, which is a way of smoothing out the effects of interest rates on our income. And that's part of what is causing our NII expansion over the last couple of quarters. So we are pretty well protected against changes in interest rates in the near term. As far as the budget, look, this government has come in with a very smooth transfer of power, which is, I think, a great credit to the United Kingdom. It shows also the strength in the institutions of this country. And then next, I think they understand the importance of investment and growth. We had, as you know, a very successful investment summit in the UK last week. And the importance of the financial industry and the banking sector in particular in partnering with the government and partnering with other private agencies in fueling growth. So I'm optimistic for the growth plans that will be in the budget. Of course, we don't know the details. We'll see them like everybody else. But, so far, very optimistic about the desire, the intention, and the ability to execute.
Can I ask you, though, as a follow-up here, to what extent that optimism that you're seeing, the growth outlook, by the way, obviously the IMF has also increased the growth outlook for the UK economy for this year and next. To what extent will that actually be translated, and how will that materialize in broader valuations when it comes to the UK market? We know that the UK market is very, very cheap. It trades at a huge discount to the US market. And if I take a look at your shares and your tangible book value at 0.6, your stock looks too cheap for the optimism that you're giving us.
Yeah, so I'll leave the stock price alone. I think it's done well so far. And I hope it continues to reflect the growth in the economy and our own performance. As far as the UK itself, look, in our plan at the start of this year, we said that we were going to invest £30 billion of risk-weighted assets in the UK, well before the elections, well before this rally. We also bought Tesco Bank for about £8 billion of assets, which is a very large retail-oriented bank in the UK. And we think that with growth, there will be, in particular areas, whether it's clean tech, whether it's far parts of pharma, and most importantly, housing, the ability for banks to help finance new activity in what I hope is a profitable way in risk-return terms. So we think that there are good prospects for those who want to invest in the UK. And we certainly are doing that.